Hello everyone, and a very warm welcome to another edition in the nk.tax series of property tax planning briefings. This one is affectionately called One Day Son, 60% of all this will be yours. My name is Martin Beadle, and I'm going to walk you through one of the most simple, straightforward legacy planning techniques that's available to all property owners just like you. And let's jump right in. If you own property and if you've got kids that you like, then this applies to you. In the next 20 minutes, I'm going to show you how to choose your tax future, because if you don't, Her Majesty's Revenue and Customs will do it for you. That's the default position. That's what happens, and that's a fact. I want you to realize what's possible, and I want you to do this one thing today. For the next 19 minutes, I want you to think, please really think about the legacy you've built for your family and what will happen to it when you die. How do we know what happens? Well, that's exactly what our tax team does most days of most weeks for property owners just like you. I'm going to tell you about the golden goose, and I'm going to give you the ingredients for the secret sauce that we use to make sure it's cooked to perfection. We can do all that in just a few hours because our property tax team has spent more than 25 years finessing how it's done. Okay, let's start with the problem. Did you know that if you don't plan properly, then when you die, and that might be a long time or it might be coronavirus, 40% of your entire taxable estate will go to the taxman. So let's say that your net death estate, that's the net value of your total assets when you die, is worth £1 million, and that you're either single or you're the second spouse to die. I know you're not going to like this, but it's true. Her Majesty's Revenue and Customs get 40%. That's £400,000, and each of your 3 children gets just 200,000. Now, I know you may not have 3 children, but the numbers just prorate. And let me just say that again, but in a different way, because it's important. Without proper effective planning, when you die, HMRC gets 40% of your entire net estate, and the rest is shared between your kids. So if you have got 3 kids, then HMRC gets twice as much as any of your children. HMRC gets 400,000 and your kids get just half of that, 200,000. If that's what you planned when you started out to create your family legacy, then I salute you, because in more than 30 years of doing this, I've never yet met anybody else started out wanting HMRC to be the biggest beneficiary of their estate, i.e. the biggest beneficiary of their entire lifetime's work. And that's the default position, unless we plan. And that's what we're here to talk about today. And here's why. Stupidity tax, as I call it, or inheritance tax, IHT, as HMRC calls it, with proper planning is entirely avoidable, and everyone has the legal right to do so. And let me just say that again. Inheritance tax in the UK is entirely voluntary, and you are absolutely free to organise your affairs in any way you wish so as to legally avoid paying tax on the stupid. Now, I don't mean that you're stupid, but what I do mean is that not taking action to put the interests of you and your family ahead of HMRC could be construed as stupid, and that's why I call it stupidity tax. And that's not all. All it takes is simple planning, and that's what I'm going to talk to you about right now. This affects anyone who owns investment property, and that can be residential or commercial or both, or land. Right now, I'm going to talk about family investment companies, and that's something you're going to want to know about, because where they fit, and that's most everywhere, they really are efficient and effective planning tools. Coronavirus has brought sharply into focus the need to plan for passing assets to family members if the worst happens, and I'm going to tell you exactly how to do it. Simple. As always, I'm going to go through this a mile wide and an inch deep, And then we'll organise a free meeting by Zoom with our property tax team for those who want to go an inch wide and a mile deep into their own personal circumstances. Okay, so what is a family investment company? Well, a family investment company is a general term used to describe a special type of UK company which is registered at Companies House along with all the others, and which is created to hold investments for members of your family. Typically, we use them to hold residential or commercial investment or rental properties, but it could be just about any type of investment. Most often, we use them as tax-efficient vehicles to pass wealth down the generations or to share it with children or other family members, and that's what we're going to focus on right now. Family investment companies are simple, straightforward, and effective. They're cheap to set up, simple to run, and entirely within all of Her Majesty's Revenue and Customs rules and regulations. I'm going to focus today on family investment companies for married couples, but they work equally well for unmarried couples. There's just a bit more work to be done in planning for inheritance tax. Similarly, a single parent can use a family investment company every bit as effectively as a couple, because it works for just about anyone who wants to pass their investments to their family. And it doesn't have to be direct family. It could be nieces or nephews, siblings or friends. The point is that you get to choose, not HMRC. And let's just pause there for a spoiler alert. Family investment companies are of no use to people who actually want to give the lion's share of their legacy to HMRC when they die. So if you dislike your children more than you dislike HMRC, your job's done. Mission accomplished. You can go and get on with your day. Okay, so now let's look at how it's done. At its most simple, all that's required is an off-the-shelf company with just a nominal value of, say, £100. That's the easy bit. The share structure of the company is likely going to require some real thought and consideration to make sure the various types and classes of shares properly match your exact requirements in terms of who gets what, when, and in what circumstances, and that's what we do for you. The next step is to transfer shares to your children or other beneficiaries, and that's got to be done before the new company actually does anything, and ideally while it's still just an empty shell. The reason for that is that the transfer of value is very small, which, if we do it right, is just the nominal value of the share capital and should be covered by your annual CGT exemption. Then you transfer all or some of your investment properties to the company in exchange for an interest-free loan, which, and you'll like this bit, is repayable to you on demand. That means that when cash builds up in the company, say from rents, you can be repaid without paying tax on the income. But, and it could become a big but, unless you actually spend the money, you're not helping the IHT problem. As you'd expect, that's our job, and we sort that for you. Of course, the loan account means you've received full consideration or full value in layman's terms, so no transfer of value has taken place, which means that no IHT charges can arise. Now let's look at the practical problems and how we're going to solve those for you. In today's world, lots of properties have mortgages or other debts, and while that makes it a bit more difficult, it is usually possible, and that's where our hands-on property tax experience is invaluable. You just leave that bit with us and be secure in the knowledge that we do that all the time for clients. We do need to give some thought to the loan account itself, because that has a shelf life of 21 years maximum. And what that means is that if mum and dad are going to rely on loan repayments for, say, income, then it'll run out after 21 years and their income will have to come from other sources at that stage. Of course, and logically, if that's likely to be an issue, typically because of age and life expectancy, then we just put some of your properties into the family investment company and leave you with the others, and you get to keep the income that those generate. We do need to aim to get that about right, because if the children or the family investment company support mum or dad, that would bring the value of the shares back into the taxable estate for the purposes of death taxes, i.e. for inheritance tax. There are several ways of dealing with living too long, one of which is to downsize the family home and live off the income generated by the difference in value. Or you could take a lifetime mortgage and use the proceeds to generate income, which means you don't have to move, and that may further reduce the IHT liability on your estate. We've encountered a few practical problems over the years, so let's have a look at those before we move on with how to deal with them. Most obvious is the practical issue of actually running the family investment company. Typically, mum or dad created the business, made the decisions, and created the family legacy for the children. Children come in all shapes and sizes, and while we tend to think ours are the best and they're all geniuses, experience tells us that isn't always the case. So maybe you need some rules and regulations. You might need to address all the what ifs before they arise. And let's be honest, it's only mum and dad that can do that. So we need you to make the rules. Tell us what you want to happen during your lifetime and what you want to happen to your family investment company when you die. Okay, we're starting to run out of time, so let's take a quick walk through some of the planning issues, and we'll start with golden shares. If mum and dad have any concerns about their kids managing the family investment company, they can retain what's called a golden share. And the golden share doesn't receive any dividends, it's not transferable, and it's cancelled on second death, i.e. when the second parent dies. The golden share doesn't have any real monetary value, but it does have the power to remove or appoint directors. And what that means is that parents can intervene if necessary to make sure the family investment company runs smoothly. A quick look at dividends. Each shareholder can receive up to £2,000 of tax-free dividends each year. That's not much, but it might be useful to children. What about situations where you're just plain not sure that the kids are up to running the family investment company? Well, instead of gifting shares directly to your children, you could gift them to a trust. And the real use of a trust is where you want to retain some control over the shares, say until a future date or age, which you feel is more appropriate, perhaps age 25 or 30, because different kids mature at different ages, and mum and dad are the best place to call that one too. Maybe capital gains tax, that's CGT, on transferring assets to the family investment company is going to be an issue. Well, here we start to get into technical areas which are really beyond the scope of this presentation, but what I can say is if there's time to plan, then there are several options, all of which are within UK generally accepted accounting principles, i.e. GAAP principles that all accountants apply, and most CGT issues can be properly planned for. And there are several other equally effective planning techniques which might be even more suited to your particular circumstances, and we'll talk about those in our one-to-one Zoom meeting, which I'm just about to invite you to. Maybe now, ahead of the worldwide recession, which most people seem to be predicting, is a really good time to plan because lower property prices mean less tax to pay. There's good news in everything, you just have to look deep enough. The same principles apply to stamp duty land tax, SDLT, where an additional step in planning may be required before the properties are transferred to the family investment company. That's one of the areas where our experienced property tax team are particularly adept. Last, but definitely not least, there's pension planning. If mum and dad continue to be involved in the family investment company, then it may be possible to make pension contributions of up to £40,000 a year and get full tax relief on the contributions. In some cases, the pension contribution can be more, perhaps very much more, but that's a separate conversation with our retirement planning specialists. So let's just remind you why you need to do this. Your children, or whichever beneficiaries you choose, benefit in whatever proportions you want, not HMRC. The loan account effectively provides you with tax-free income. There's no transfer of value, so your IHT saving starts straight away on day one. There's no immediate IHT charge, and that's on all transfers, not just those above the nil rate band. And importantly, perhaps most importantly, profits and capital gains are subject to corporation tax at just 19%, instead of income tax at up to 45% and capital gains tax at 28%. Okay, so now you know something about one of the several planning options available to you. Let's just deal with the excuse that we hear more than any others, and that's, I've got an accountant. Well, yep, so have we. So has everyone in business. Ours is very good at general day-to-day stuff. She does our annual accounts, payroll, tax return, company's house return, management accounts. She helps us with projections and lots more, because, as she says, her job is to prepare and examine the financial records and make sure they're accurate and that taxes are paid on time. We kind of think of her as an HMRC policeman who we have to pay for. Now, in our experience, most small accountants simply don't have the time and resource necessary to keep right up to date with technical property tax in what is a very fast-moving and highly bespoke field of planning. But here's the thing, they can't actually tell their clients that's the case for fear of losing their client and the annual fee income that they get paid. And if you just think about that for a second, it makes sense, doesn't it? Let's look at it another way. I'm guessing you likely know from your own experience that you can do a lot of the general work on your property portfolio yourself, but there are some things for which you just need an expert. You maybe need a craftsman when it comes to quality joinery, for example. I'm guessing that not too many of you say, Dave, that decking looks great. I love the colour you've painted the garage door. Now have a go at fitting my £150,000 small bone kitchen. I'm sure Dave's a great guy and you've known him a long time, but no, that's not going to happen. And it's the same in the tax world, or it should be. You need good generalists to do the day-to-day stuff, the management accounts, projections, payroll, VAT, audit, and so on. But you need a specialist to do the property tax planning. Specialist property tax advice is what we do for clients just like you every day of every week, because you simply cannot afford to get this wrong. And here's the thing, if your accountant had already done this for you, or even knew enough to bring it to your attention, then frankly, you wouldn't be listening to this webinar, would you? So here's what I want you to do right now. Just follow the link in the description box below and enter your name and email address to book a free property tax strategy session with one of our experts. It's the smart thing to do, and I want you to do it right now, please. It's an intense, free, hour-long session because it's critical you know where you stand. We'll take your information that you give us and we'll map out a plan for you entirely free. And since there's no risk, no obligation, and no cost, there's nothing stopping you. Once that's done, you can feel the way you should about your legacy, safe in the knowledge that when you die, your assets will go to your chosen beneficiaries, to your kids or your grandchildren, and not to the taxman. Again, the link to book a free property tax strategy session with one of our experts is in the box below. Your kids are going to thank you. Okay, till next time.